Welcome back to the deep dive. We are jumping into a really fascinating realm today, one that I think cuts right to the heart of a lot of financial stress. So I want to start by asking you, the listener, a simple question. Are you disciplined? Are you working hard, maybe skipping that daily $5 coffee, tracking everything? And yet, no matter how hard you try, you just feel like the goalposts keep moving, like you're always falling behind.
It's an incredibly common frustration. I mean, we're all taught to manage our money with this consumer playbook, right?
Mm-hmm.
It's all about a basic budget, focusing on monthly cash flow,
Mm-hmm.
what a corporation would call a P&L, a profit and loss statement.
Right.
But the sources we looked at this week argue that this whole P&L mindset, it's actually the trap. Think about it.
Mm.
Billion-dollar companies, they don't obsess over their version of $5 coffee. They engineer their balance sheets.
And that's our mission today. We want to give you that corporate playbook to help you move from being a consumer budgeting against inflation to a capital strategist who's actually leveraging it. Okay, so let's unpack this. We've got a real world play-by-play that shows this shift in action. It's the story of MicroStrategy, MSTR, and its executive, Michael Saylor.
Right. And before 2020, MSTR was, well, it was pretty unremarkable.
Totally. A standard digital software company selling SaaS products. Their stock was flat, revenue growth was flat. They just couldn't compete with the tech giants like Microsoft or Google. They were, functionally stuck.
And Saylor saw this. He recognized they'd hit a ceiling trying to compete on the P&L. They just couldn't out-innovate or outsell Microsoft. So he made this truly drastic, almost radical move.
He abandoned the P&L focus entirely.
Entirely. He shifted the whole financial architecture of the business. He converted MSTR into what he called a treasury-based company. Their new focus was just accumulating Bitcoin as the core treasury asset. They basically stopped being just a software company.
And became a capital structure, an optimized capital structure.
That's it.
And the results, this is why we're doing this deep dive. Since that shift in 2020, MSTR stock is up 83%.
83%. And it's crucial to understand, like you said, this isn't because their software suddenly got amazing.
No, not at all. It's pure financial engineering.
Yeah.
And that 83% gain has just crushed every major asset class out there. Our sources show MSTR has outperformed Bitcoin itself. It's beaten the Magnificent Seven tech stocks, which are up maybe 28% in that period.
And gold, the S&P 500, bonds, real estate, it's not even close. That one data point should fundamentally change the traditional advice we all get about where to put our money.
It really should. The scale of this change is it's mind-boggling. 5 years ago, MSTR's enterprise value was sitting around, $3.6 billion?
$3.6 billion.
Yes.
Today, it has ballooned to $98 billion.
$98 billion. So now they're in the top 5 companies globally by treasury size. They hold about $71 billion in assets. They're literally in the same league as Amazon and Berkshire Hathaway, not from selling more software, but from optimizing their capital structure.
But here's the key component, the part most people miss, the leverage. They didn't just buy Bitcoin with cash they had lying around. They used strategic debt. They're holding that $71 billion in Bitcoin assets against only $13 or $14 billion in debt.
Right. And that aggressive use of fixed debt paired with an appreciating asset, that was the secret sauce. That was the ingredient for that massive wealth multiplication.
And that corporate playbook leads us directly into our next section. Why the traditional consumer budgeting frame just fails you. If MicroStrategy couldn't win the cash flow war against Microsoft, how can any of us expect to win the cash flow war against inflation?
The rules changed. There was a quote in the source material from Einstein that I loved. His assistant was worried students had the answers from last year's test, and Einstein just said, the answers changed.
And that's exactly what happened. The financial system moved from being backed by equity and gold to being a debt-based monetary system. The answers changed.
But we're all still using the old answer sheet.
We are. And that consumer trap is universal, isn't it? Strict budgeting, trying to cut costs everywhere, working a side hustle, obsessively paying down all your debt as fast as you can.
Yeah, regardless of the interest rate, just get out of debt.
Exactly. You're applying immense personal discipline to a structural problem.
And that structural problem is inflation. We usually think of it as just, prices going up. But our sources define it as working against us in 2 specific ways. Yes, life gets more expensive, but the big one is that it creates debasement. Can you just unpack that idea of debasement for us?
Yeah.
Because that feels like the core obstacle.
Debasement is the active structural erosion of your purchasing power. So think of it this way. If you have $100 today and inflation is running at 5%, next year you need $105 just to buy the exact same stuff.
Right.
No amount of personal discipline can stop that. The sources are definitive on this. The rate of that systemic debasement is structurally greater than the rate at which most of us can save or get a pay raise.
So even if I'm saving $500 a month, that $500 is worth less every single day it just sits there? My cash flow is fragile.
Its purchasing power is constantly being stolen. Precisely. So if MSTR realized they couldn't generate enough cash flow to compete, that's the lesson. Focusing purely on your P&L performances, it's a dead end.
So the secret is to stop protecting short-term cash flow and start structuring your assets on the balance sheet for the long term. You have to start thinking like a financial engineer.
Which brings us to the new language, the 3 pillars of this strategy.
Okay, let's redefine the terms. We're moving from tracking expenses to structuring capital. The framework we're introducing is balance sheet asymmetry, debt as a tool, and leverage.
Pillar 1, balance sheet asymmetry. It's just recognizing that inflation, this structural force, affects your assets and your liabilities in completely different ways. We already know it crushes cash flow. That's bad.
But here's the counterpoint. Inflation actively destroys or decays fixed liabilities. So my monthly payment on a 30-year fixed-rate mortgage, let's say it's $1,000 a month. Today, that feels like a lot. But in 20 years, with inflation, that $1,000 in purchasing power becomes almost trivial.
Right. The inflation is working for you to erode the real value of that debt. That's the asymmetry. That's the opportunity. 2 people can have the same income, but have wildly different financial outcomes based purely on how they've structured their long-term liabilities against that force.
Which brings us to pillar 2, and this is the one that's a huge mental hurdle for most people. Seeing debt as a tool, we're just conditioned to think all debt is evil. It must be destroyed.
But we live in a debt-based monetary system. I mean, that's how money is created, through debt. The debt becomes an asset, which becomes collateral for more debt. If the whole system of wealth creation is based on debt, you can't just opt out and expect to win.
The analogy of the knife from the source was great.
It's a perfect analogy. Debt is a tool. In a child's hands, a knife is dangerous. In a master chef's hands, it's essential, it's powerful. Look at Apple, Google. The Magnificent Seven. They carry billions in debt, even with huge cash reserves. They aren't broke. They're using it to engineer wealth.
Okay, that's a powerful point. But when the average person hears take on more debt, they're thinking 2008. They're thinking high-interest credit cards. How do you draw that line? How did MSTR manage their risk?
That is the critical distinction. It's about fragility versus leverage. High-interest credit card debt for, say, a vacation, that creates fragility. But strategic fixed-rate debt used to acquire an appreciating mobilized asset that creates leverage. MSTR avoids fragility by having massive reserves and long fixed durations on their debt.
So the consumer version of that is having a liquidity buffer. Don't get overextended.
Exactly. Don't face a margin call. The distinction is fragility versus structural strength.
Which leads us right into pillar 3, leverage. Institutionally, it's about controlling an asset much bigger than your own equity base.
So you might only have $100,000, but with strategic debt, you can control $1 million asset. Let's just run the math to make it really clear. You buy a $100,000 asset with cash, it goes up 10%. You make $10,000, that's a 10% ROI.
Standard. Makes sense.
But you take that same $100,000, use it as equity to control a $1 million asset, that asset goes up 10%. That's a $100,000 return.
$100,000 on the same initial capital. That's a 100% ROI.
100%.
10% versus 100%. The math is it's undeniable.
That's the corporate playbook. Maximize the return on the equity you own, not just the asset itself. And again, the risk isn't the leverage, it's the fragility. It's mismanaging the tool.
Okay, so we've learned the language, we understand the pillars. Now, the goal. Structural arbitrage. Before we get into a practical example, what does that actually mean in simple terms?
It's just about arranging your debt and your assets so that your assets gain value faster than your fixed liabilities cost you in interest. It's a structure where the different parts of your balance sheet are literally working against each other for your net benefit.
Which means we have to stop seeing our balance sheet as static. That idea of idle capital comes back. If my money is just sitting in a 401k making a predictable 8%, it's actually decaying. Its purchasing power is being lost faster than it's growing.
That idle balance sheet is a massive opportunity cost. In this system, cash is the fuel. It is not the safety. Safety comes from asset quality and liquidity, not from holding cash that's being structurally destroyed.
And the good news, according to our sources, is that intent matters more than size here.
Absolutely. Even as a consumer, you have the same fundamental tools as a multi-billion-dollar corporation. You have a balance sheet, your home, your investments. You have access to credit, ELOCs, credit lines, which, by the way, you should work to clean up and apply for now. And you have equity.
So let's walk through that practical example from the source material using dormant home equity, because this is where it gets really actionable.
Okay, let's take a listener scenario. Say you own a home worth $200,000 and you owe $100,000. That means you have $100,000 of dormant equity, capital that is sitting there doing nothing but decaying.
So, action one, mobilize the capital. You unlock that 100,000 using a HELOC or a refinance. Let's say the interest rate on that new debt is 7.5%.
Okay, so now you have a fixed liability of $100,000 at 7.5% annual interest. Action two is the structural arbitrage. You take that 100K and you invest it into a structured product. Let's say it's a convertible note linked to a high-growth asset, maybe like the one related to MSTR. That's paying a fixed income of 9.5%.
Okay, so right away, the math is simple. You pay 7.5% on the debt, but you're earning 9.5% from the investment. You've got a positive carry of 2%. You are literally getting paid to carry debt.
You're getting paid. And this is where the financial engineering really shines. If this is structured correctly, that interest you pay can be tax deductible. The investment growth is tax deferred. The sources showed that your 2% positive carry can easily be engineered closer to 4% after you account for those tax advantages.
So you're being paid 4% on capital that was previously just sitting there eroding.
And that's just the cash flow part. The real multiplier is the potential capital gains. That structured product, it often has an equity upside, the ability to convert into, say, MSTR shares when the stock hits a certain price, a strike price of $1,000 a share, for example.
And based on some of those projections, if Bitcoin hits $1 million by 2030, those models push MSTR's share price to $3,000, maybe $3,100 a share.
Exactly. So that single action demonstrates the whole thing. You took dormant capital, you applied leverage, you created a positive cash flow stream from the carry, and you positioned yourself for massive long-term capital gains. You're forcing your money to do 2, maybe 3 jobs at the same time. That is the corporate playbook.
So it all comes back to this one core takeaway. The choice is fundamental. It's between managing a fragile P&L, a budget that's always fighting a losing battle with inflation, or engineering a robust balance sheet that actually uses inflation to your advantage.
You use it to decay your fixed debt while your leveraged assets appreciate. It's about accelerating wealth without just working harder.
It's getting your money to work smarter and exponentially harder than you do. This is the difference between surviving this financial system and actually thriving in it. You move from being a consumer victim to a capital strategist.
Exactly right.
So here is a final provocative thought for you to chew on this week, and it's based on that principle that intent matters more than the size. We challenge you to look at your personal balance sheet right now, not your budget, your balance sheet, and identify one asset that is currently sitting idle and decaying. Maybe it's home equity. Maybe it's just a big pile of cash in a low-interest savings account. What is the opportunity cost of that lazy capital? And challenge yourself to start viewing debt not as an enemy to be eliminated, but as a manageable tool to leverage your way out of this consumer cycle and into the world of capital strategy.